Welcome to the first of two videos on the basic concepts of double entry bookkeeping. Double entry bookkeeping is the modern and virtually universally utilized method for recording and analyzing financial transactions. It was first evidenced in the financial transactions recorded during the height of the Roman Empire over 2,000 years ago. The modern version began to evolve during the 15th century by Italian merchants whose enterprises were expanding rapidly due to the rise of international trade across the Mediterranean Sea. When it became obvious that unwinding financial records to find mistakes was complicated, cumbersome, and time-consuming, they realized that they needed some way of catching mistakes early and continuously throughout the entire process of recording and analyzing financial data. The famous Italian mathematician, Franciscan friar Luca Pacioli, has come to be called the father of accounting because of a book he published in 1494, Summa Arithmetica Geometria, which contained a section documenting the basic conventions of the double-entry bookkeeping system. By the way, the term bookkeeping is the only word in the English language with 3 double letters in a row. Here are the basic concepts you'll be learning in this and the next video. Debits versus credits, journals versus ledgers, and income statements versus balance sheets. You will also learn the difference between the accrual and the cash basis of accounting, the purpose and use of a trial balance, and why and how to close the books. Let's start with the concept of debits and credits. When you're a college student, you can usually keep all your relevant financial data in your head. $1,000 a month from a fellowship, $500 a month from a job, $800 a month from your parents, but you have to pay $400 a month in rent, $500 in food, maybe $1,000 a month in entertainment. From this information, you can easily conclude that you'll have $400 a month to blow on books, transportation, and clothes. But as you get older, your life gets more complicated, particularly when you make more money than you need to spend in a month, you take a spouse, purchase a house, and especially have children. This is when you'll need some system for recording your financial data. Businesses have all sorts of financial documents and analytical tools that help them keep track of their relevant financial data. At the basis of it all, however, is a concept that can best be expressed by the equation of net worth. This equation is merely an expression of the relationship between assets, liability, and your equity or net worth. The equation is intuitively obvious. Assets are what you own, liabilities are what you owe, and the difference between the two is your equity or net worth, which is how rich you are. So the equation of net worth is, quite obviously, equity is equal to assets minus liabilities. This expression simply says that your net worth is the difference between the value of what you own and the amount that you owe. It seems simple enough on the surface, but when you have multiple sources of income, many different bills to pay per month, own many different things like houses, cars, furniture, appliances, clothes, miscellaneous junk, etc., some of which you still owe money on, keeping track of one's financial situation can be daunting. Once those old Italian businessmen figured out that finding an accounting error was like finding a mistake in a Sudoku puzzle, they knew they had to develop a way of catching those mistakes before they compounded. As a result, a system known as double entry bookkeeping emerged as a way of catching mistakes early. This method of bookkeeping required that each financial transaction be entered twice. First, from the perspective of a debit, and second, from the perspective of a credit. In the context of double entry bookkeeping, there is nothing inherently good about a credit, nor inherently bad about a debit. Some people think that debits are bad and credits are good, but as you will soon see, these are just words. There's nothing inherently good or bad about a credit or a debit. Accountants rearrange this equation of net worth to be more useful for the purposes of double entry bookkeeping, with a few simple changes like moving L to the other side of the equation, all within the rules of algebra. We get the following equation: assets are equal to liabilities plus equity. While this equation is not as intuitively obvious as the first one, this rearrangement did not violate the rules of algebra, so it's just as true. So here's the way we use debits and credits. Any financial transaction that results in an increase in the value of your assets, on the left-hand side of this equation, is defined to be a debit. Any decrease in an asset is considered a credit. On the other hand, any increase in a liability or equity on the right-hand side of the equation is a credit, while a decrease in either is considered a debit. For every transaction, the value of the debits must equal the value of the credits. Every financial transaction is listed twice. That's where the term double entry comes from. Once from the perspective of a debit and once from the perspective of a credit. You'll see an example in just a little while. But if the debits don't equal the credits, you've made a mistake. You have to back up and start again. But where do you list these transactions? These transactions are listed in a document that accountants call a journal. A chronological record of every financial transaction is recorded in the journal. It is here that debits and credits are listed as they occur. Journal entries can be recorded upon either the accrual basis of accounting or the cash basis of accounting. Using the accrual basis of accounting, you'd record income in the journal when it is earned and expenses when they are incurred. Using the cash basis of accounting, you'd record income when it is received and expenses when they are paid. If, for example, you hired me to paint your house for $1,000, with the accrual basis of accounting, I'd record that $1,000 when I finish painting the house. If I used the cash basis, I wouldn't record the $1,000 until you actually paid me, maybe 2 weeks later. For journal entries, it doesn't matter which basis you use for recording income and expenses, as long as you are consistent. However, for the budget, when we finally get to it, you should always use the cash basis of accounting for recording anticipated income and anticipated expenses. Let's consider some examples of journal entries. Here is basically what a journal looks like. This column identifies the account or the accounts that are affected by the financial transaction. Many journals also include a column for a description of the transaction. An account is simply a category of a financial transaction. Transaction number 1. On January 1st, you paid $100 cash for a rare baseball card. This rare baseball card is an asset. It is something that you now own, and it can be resold in a secondary market, and thus has market value. A secondary market is a market where used or previously owned goods are bought and sold, and whose value is determined by supply and demand. If there were no secondary market for this asset, hypothetically, it could not be sold and therefore would have no market value. This transaction would be considered an expense then, rather than the purchase of an asset. You might indeed be able to sell it, maybe on eBay or Craigslist, but But a lack of a formal secondary market would mean that the sales price for that asset would be unpredictable and a bit random. You couldn't adequately assess the value of the asset for accounting purposes because the value of the asset, that is, the amount for which you could eventually sell it, would be unknown. Okay, so recall the transposed version of the equation of net worth and the definition of debits and credits. In transaction number 1, we see an increase in an asset, the baseball card, and a decrease in another asset, cash. There is actually an active secondary market for baseball cards. You could probably look up the price at which you could sell it online. But let's call this account collectible assets because a baseball card account is just too narrow. This hypothetical category might also include rare stamps and coins, maybe even old paintings and classic cars, but nothing that could not be sold in an existing secondary market. Your rubber band collection, for example, probably wouldn't qualify as an asset. Even active secondary markets are not totally predictable. Stocks, for example, change in value every day. If you spent $100 on XYZ Corporation stock, you can be sure that the value of that asset would not be $100 tomorrow. It could be more or it could be less. So you might get more or less than $100 for this baseball card if you actually tried to sell it in a secondary market. But for right now, record its value as the price that you paid. As you learn more about accounting, you'll see how adjustments in asset values can be made. Because you paid cash for this baseball card, and cash is an asset, the reduction in cash is recorded as a credit. There, we've completed transaction number 1. As you can see, the value of the debits and the value of the credits are equal. So we haven't made a mistake yet. So now we can move on to the next transaction. Transaction number 2. On January 2nd, you loaned a friend $500 and he gave you an IOU. Now this IOU can be considered an asset if this agreement is a legal contractual obligation on the part of your friend. Otherwise, it might just wind up being an expense. This IOU, we'll assume, is indeed an asset because your friend is legally obligated to pay you back. The general account name for all debts owed to you is accounts receivable. Now, a business might parse it out with a little more detail, but this very general term is probably good enough for the finances of a household. Once again, the cash account is credited because this loan represents another reduction in cash. Again, our debits and credits are equal for this transaction, so no mistakes yet. We can move on. Transaction number 3. On January 3rd, you bought a used car for $5,000, paying $1,000 down and borrowing the remaining $4,000 from the seller. We'll debit the car account because it represents an increase in an asset. Like the baseball card, we'll just record the value of this asset as the price we paid for it. We may or may not be able to actually get $5,000 for it in the used car market. Now, the process of reassessing and adjusting the market value of this and other assets and recording it in our account ledgers is beyond the scope of this course. That's accounting, not bookkeeping. And we paid out $1,000 in cash. Now, that's another reduction in cash, so we'll show that as a credit. Like accounts receivable, this term accounts payable is a standard name given to a general category that includes all the debts you owe. And we'll credit that $4,000, the amount that we owe, because an increase in a liability is a credit. As you can see, the debits and credits are equal for transaction number 3. So now let's go to transaction number 4. On January 4th, you used your debit card to buy $200 worth of groceries. When you use your debit card, you're transferring money from your checking account into the seller's account. We'll see why it's called a debit card shortly. A drawdown in your checking account, because it is an asset, is recorded as a credit. To offset this credit and keep everything balanced, the expense would have to be recorded as a debit. So here we've recorded the grocery expense in the debit column. Lots of people think debits are bad because it represents a loss of money, as in this case. But if you draw down your cash or checking or some other money account to buy an asset, that drawdown would be recorded as a credit, as in transactions 1, 2, and 3. And you debit the asset account, whatever it is you purchased, a baseball card, an IOU, or a car. So debits aren't inherently bad, despite the fact that expenses are indeed recorded as debits. And here we have credited the checking account because that's what you do when you draw down an asset. Let's take a moment to distinguish between an expense from the purchase of an asset. When you purchase an asset, you are buying something of value. Value, in this case, defined to be something you could sell on a secondary market. With an expense, however, you are buying something that you cannot resell, like your rubber band collection or some service, like having someone mow your lawn, or maybe when you buy a gallon of milk. These have value to you, but you can't sell them. So in an accounting sense, they have no value. As a result, other than a drawdown in some money account, which is recorded as a credit, no other variables in this equation of net worth are affected by an expense. So other than the drawdown in your checking account, which was recorded as a credit, this expense did not change the value of any of these variables in the equation of net worth for now. We will, however, adjust the equity account when we close the books. You'll learn about that process in the next video. Just a quick check here, and we see that our debits and credits are equal for transaction number 4. Before we go on to the next transaction, a brief review. An expenditure is spending money to purchase an asset. It will result in an asset account being debited. An expense, on the other hand, is spending money on something that cannot be recorded as an asset. Maybe because it's not tangible, such as a service, or maybe it is tangible but cannot be readily resold because there's no secondary market. Your purchasing another rubber band for your collection will not result in the rubber band account being debited, nor will the purchase of groceries, as in this example. There is no milk account or Fruit Loop account. Transaction number 5. On January 5th, you used your credit card to buy $100 worth of clothes. When you use your credit card, you are borrowing money from the bank. It's called a credit card because when you borrow money, you incur a liability. An increase in a liability is recorded as a credit. Like the groceries, this transaction is considered an expense because rather than buying an asset, you have nothing of value to show for the money you spent. Unless it's one of Elvis's outfits or maybe Abe Lincoln's top hat, there is no secondary market for clothing, and therefore, once you buy it, it has no marketable value. Therefore, this expenditure must be recorded as a credit, an increase in a liability, to your credit card account. And to offset this credit, your clothing expense, like your grocery expense in the previous transaction, must be debited. This expense on clothing will cause an increase in a liability, but no offsetting adjustment for the time being in the value of any of these other variables in the equation of net worth. But if we're going to keep everything balanced, something in this equation of net worth should have an offsetting adjustment. That will happen when we adjust the equity account when we close the books. Before we go on to the next transaction, let's just check and see if our debits and credits are equal. And indeed they are. Transaction number 6. On January 6th, your paycheck from Acme Widget Company was direct deposited into your checking account in the amount of $1,000. This transaction is very similar in an important way to transactions 4 and 5. In those transactions, you spent money, but an asset was not purchased. It was therefore recorded as an expense. An expense occurs when you spend money but receive nothing of marketable value in return. In this transaction, you received money, but an asset was not sold. So it is therefore recorded as income. Because the value of your checking account, an asset, rose by $1,000, this transaction is recorded as a debit. But you gave up no physical property of marketable value, so there's no asset account to credit to offset that debit. Nor did you get that money by borrowing it, which would have resulted in crediting a liability. So there's no offsetting credit when your checking account increased by $1,000. It's as though the money just fell from heaven. So to offset this debit, we will create an account that we can credit. We will call it income from Acme. So as you can see, when you get paid, your income account must be credited. Income is, of course, the opposite of an expense. But income and expenses are alike in one important way. For each, there is no change in any of the variables in the equation of net worth to offset the credit when your cash goes down, as in the case of an expense, or a debit, as in the case of income, when your cash or the value of your checking account goes up. But this situation will eventually be resolved by adjusting the equity account when we close the books. Again, before we move on, note that our debits and credits are equal. Transaction number 7. On January 7th, your friend paid you back in cash the $500 that you loaned him on January 2nd, plus $50 in interest. Just like the transaction on January 3rd, this is a compound transaction. As in that transaction, one account will be debited and two will be credited. Let's take this transaction one step at a time. Your cash account increased by $550. Because cash is an asset, the cash account is debited. There's the debit of $550. But because he paid you back, your accounts receivable account has decreased by $500. Because accounts receivable is an asset, this account is credited. A decrease in an asset, recall, is recorded as a credit. Notice that the debits exceed the credits so far by $50. Obviously, we need to find another $50 in credits. Your friend paid you $50 for the service you provided him, lending him money. Income, recall from transaction 6, is recorded as a credit. To distinguish this income account from your wages from Acme Widget Company, we'll call this account interest income. And income, of course, is recorded as a credit. In this transaction, assets were debited by $550 and credited by $500. No further adjustments will be made in this equation for right now to resolve this imbalance. That won't happen until we close the books, at which point the equity account will be credited so that ultimately the debits will equal the credits. As you can see, however, the debits and credits do add up in our journal. That's because we invented an account that we could credit, interest income, which is neither an asset nor a liability. We invented it just to make sure that our journal entries are balanced. Transaction number 8. On January 8th, you used your credit card to pay $80 in interest on your student loan, but you didn't pay any on the principal. As you know, when you use your credit card, you are borrowing money. And of course, when you borrow money, you incur a liability. And an increase in a liability is a credit. When you pay interest, you are not receiving a physical asset with marketable value in return. You're paying for a service, the service provided you by the lender. Hence, an interest payment is an expense. An expense is recorded as a debit. And the liability incurred by the use of your credit card is recorded as a credit. And finally, notice that the debits and credits for this transaction are equal. Be sure to watch the accompanying video as soon as you can, the link to which is in the description box below. In that video, you will learn how to construct and utilize ledgers, income statements, and balance sheets. You will also learn about the trial balance and the process of closing the books, to which we referred so often in this video. With your understanding of these concepts, you'll be able to utilize your knowledge of bookkeeping to perform an assessment of your own financial situation. Be sure to watch Double Entry Bookkeeping 2, the link to which is in the description box below.